Covered call ETFs are popping up everywhere these days, from JEPI to JEPQ to many of your favorites, all promising strong monthly income and downside protection. But are they actually worth it compared to investing in the underlying index with classic ETFs like VOO or QQQM? In this video, we'll break down exactly what you give up, what you gain, and who these trendy income machines are really built for. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please swat that like button, subscribe if you haven't already, and drop me a comment below with anything that comes to mind. I still don't have a single sponsor, but I do have two tools that I use every day, Seeking Alpha Premium and Snowball Analytics. Both are linked in the pinned comment below. And right now you can save $60 on a full year of Seeking Alpha Premium, a pretty juicy sale. You know what time it is. Let's grow. Index versus income. When you invest in a low-cost index ETF like VOO or QQQM, you're signing up for 100% of the market's upside and downside. You're not messing with options or income strategies. You're just riding the market as it grows over time. The fees are rock bottom and there's no ceiling on your returns. This is a powerful combo when you have decades to compound. When you zoom out far enough, the market goes up. And when the market goes up, you won all of it. Covered call ETFs, on the other hand, are built with a different goal in mind. They still get most of the returns of the underlying index, but they carve out a small slice of the portfolio for selling covered calls. That gives you monthly income and some downside cushion, but it comes at a cost. Higher fees and limited upside when the market is firing on all cylinders. It all comes down to what you value more, growth or cash flow. Let's find out where that monthly income comes from. How covered calls work. Before we talk about the option strategy, let's take a quick step back. One of the biggest misconceptions out there is that covered call ETFs are automatically value funds or dividend ETFs. But that's not true. They're hybrids. Under the hood, many of them, like JEPQ, are actually growth ETFs, plain and simple. JEPQ is basically QQQM with a twist. It has the same growth focus, same big tech exposure, and almost an identical top 10 holdings and sector weighting. You don't believe me, do you? Let's check it out. I put together a spreadsheet that quickly shows the summary of the holdings for both JEPQ and QQQM. And we're going to start here at the bottom. This is the one that surprises most people. With your PE ratio, higher numbers are more growth oriented. And then VOO is usually like lately around 24 or so in this market. And then SCHD would be 15 or 16. You can see here QQQM, as we expect, is around 30.4, right there in the growth range. And JEPQ, which is the same underlying holdings, is 30.35, basically the same as QQQM. So these are both smack dab in the growth ETF range for their holdings. And as you can see, and we won't go over all of them, they have the exact same top 10 names in a very slightly different order. And you can see that QQQM holds a little bit more of each of its top holdings, and that makes sense because about 20% of this is the ELNs, like on the covered call strategy. So what 100% of this index is only about 80% over here, but it's proportionally the same. And that's the main point I wanted to make when I say with something like, the same amount of overall holdings, the same PE ratio. Of course, the top 10 percentage is going to be higher, and you can see by about 5.5%. And that's because the covered call strategy takes up a slice of JEPQ, which pushes all these down a little naturally, but all proportional. And you can see down to the sector breakdown, you have technologies the same, communications is the same, and consumer cyclical is the same. And the next one, I didn't bother to put them, 5 point something percent. For both of them. And all this is as of 6/9, but I just wanted to make the point. When you buy JEPQ, you are buying QQQM. You really are. Before you get into the income piece of it. You're not buying the value companies. You're buying the tech bros. Most of these things are identical. So we're not reinventing the wheel with covered call ETFs. We're just bolting on something extra. That extra is the covered call strategy. And it's what turns JEPQ from a pure growth ETF to a monthly income machine. Think of it as a high yield savings account or a money market on steroids riding on the back of a tech-focused growth ETF. But here's the trade-off. Covered calls generate income by selling away some of the upside. This is what gives the fund its monthly payouts and a bit of downside cushion, but it also puts a cap on how much it can grow. Let's trace the logic with a simple example. In our scenario, we are going to buy a single share of an ETF that directly follows an index, like a VOO or a QQQ, and then one that uses a covered call strategy based on the same underlying index. Your JEPI, JEPQ, things like that. We'll say they're both $100 per share right now, and we buy one of each. The index side of things is simple. We just get 100% of the market's returns. And this isn't going to be perfect. Forget about your expense ratios. And there's also some more complicated weighted holdings math as well, but this is just for high level concepts. With the covered call ETF, it takes a portion of the portfolio, and for $2, it sells a covered call to an outside party who gets the right to buy it anytime over the next month at $103 per share. The outside party is paying us $2 to do that. So that's that premium cash flow. Sell the covered call, get the $2 today. Now, let's look at a couple scenarios. If the index, and thus these ETFs, goes up by 10%, in the scenario that you rode with the index, you end with $110. The $100 it went up 10% or $10 a share. Nice, easy, $110, and you're still holding and chilling. With the covered call ETF, you had $100. You got the $2 of cash in the form of dividends, and we won't talk taxes here, but $102 now. But then we sold it away at that $103. It hit the strike price, and the third party's happy because they picked up something that's worth $110 for the cost of $103 for them, plus the $2 they paid. So they made net $5, and we are left with $105. A little bit of the appreciation plus the premium income. Now, what if in that last month, the underlying index went down 5%? So with the index, the simple one, we have $95. We lost $5. No biggie. With the covered call ETF, they never hit the strike price, so we kept our shares. They did not execute on the contract, and we still, of course, get that $2. So we lost the same amount of money, but we have $97 because we get the +2 no matter what. And again, in reality, you wouldn't have lost quite as much with the covered call because you only get 80%. And I'm not doing all the ins and outs. This is just the high level concepts of why the floor protection is there, but the ceiling is capped. That's the basic formula. Lower ceiling, higher floor, same holdings. Now that we have the basics on lockdown, let's bring it to life with a real-world example. The trade-off in action. We're going to walk through a side-by-side example to see how this trade-off actually plays out. For this one, I'll be comparing JEPQ and QQQM, since JEPQ is my favorite covered call ETF. But this comparison style applies to just about any of your favorite covered call ETFs, whether it's JEPI or QYLD or QQQI or anything else that's popping off. And before we dive in, remember that there are always going to be short-term exceptions in investing results. For example, the total returns of JEPQ and QQQI have tracked closely until late April of this year. And since that time, QQQI has outperformed JEPQ by over 6%. And it's things like that that inspired me to launch a new series, which will be coming soon, where I break down these covered call ETFs side by side. If you've been one of those people down there in the comments wanting me to cover your favorite covered call ETF, it's coming. But for now, let's get back to our reference example. Let's see how JEPQ and QQQM stack up. We're out here on Seeking Alpha, where I do all my stock and ETF research, and I'm on the charting tab here. I've pre-pulled this up, and I went off the inception date of JEPQ, or at least when it started getting data, and that's 5/4/2022. So we do have just over 3 years of data. Not too bad. And you can see here that JEPQ is up 46% to QQQM's 65%. With a market that has gone up overall, the index will always win. It has a lower expense ratio, and it doesn't give up that ceiling. Now you'll notice here, QQQM, the blue one, when you come here and they're about tied, you can see that on a fall, QQQM ends up a decent amount lower, but then on the rises, watch this. The market looked pretty good from 1/4/23 up until, let's call it 7/19/23. QQQM went from a decent little deficit here, 6% nearly of being outperformed by JEPQ to that point, all the way to being ahead by 7%. That's in an up market. But then you can see, look at this fall. From 7% up, it scrunches all the way down to only about 3% just in this short amount of time. And we don't have a ton of data. It's only been 3 years, but you can see the consistent picture. And by the way, JEPQ, well, I guess I don't even have to say by the way, it was ahead. You can see here early on, and people were jumping on the bandwagon, but we were in a market that went from being up to down. So it was supposed to be ahead. It did exactly what it was supposed to do. The premium income was being created and the strike prices weren't being hit, but that income continues to flow in the down market. So that's a good thing for JEPQ. And you don't have as much of the index that's falling technically as well, hence the higher floor. But when you start to get somewhere like here and you're going nothing but up, all we're doing with JEPQ is capping our ceiling. You can see that real even increase as opposed to the big jolts of QQQM, which gets every dollar working in that underlying index. And you just see the same story play out over and over. QQQM right here goes way up. It goes from an overall lead of only 4% for 2 years worth of data, explodes up by 16% in that short time frame, and then falls proportionally right back down by 6% for only a 10% lead. I've been watching this for a while as I decided to transition JEPQ to QQQM, and the leads can be deceptive. They're both good at what they do. And you can see, like, not that long ago, you'd look and be like, okay, QQQM is still ahead, but it gave up all of its lead. And now look, we've had a booming market the last month and change, and it's back up by nearly 19%. But this goes back and forth so much more than people want to say. In a down market, if this market was down, make no mistake, JEPQ would be ahead of QQQM by a decent margin if this went from here down to somewhere in here. So it's the same, only opposite, because they're the exact same index with just some different methodology. I like JEPQ. It gives me that high yield savings account that basically goes bonkers with the yield, with a slice of the portfolio, and the rest it just rides on the back of one of my favorite indices, QQQM, or more accurately, the actual index, the NASDAQ 100. So we'll see what the future holds, but if you're in or near retirement, the market doesn't always go like this over short time frames. Now, if you're a youngster and you have 20, 30 years, absolutely no doubt about it, there's probably a 99.8% chance QQQM will outperform JEPQ over the next 2, 3, 4, 5 decades. It's just math. When we zoom out, the market goes up, and it's objectively better to have an index fund during the entire duration. So it really depends on the scope that you're looking at and the goals that you're shooting for. For some people, the trade-off is worth it. For others, maybe not. And that's why we need to talk about you next. Best for your situation. There's no one-size-fits-all answer here, and that's the beauty of it. You know your investing goals better than anyone else will. If you're fully retired, you might be sipping a martini on JEPQ's dime, enjoying that monthly cash flow without ever selling a single share. Meanwhile, the 22-year-old next to you is probably riding VOO and QQQM for the next 40 years, chasing maximum growth. In reality, you are probably somewhere in between these two extremes. And now you have the tools to figure out what makes sense for your situation, and that is all that matters. Check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you here in the next one. Peace.